My name is Mike Loukas. I'm the CEO of TrueShares, and today I'm joined by two very special guests. Phon Vilayoune, the CIO and founder of Veta Investment Partners, which is a multi-billion-dollar volatility manager, and Mandy Xu, the head of derivatives market intelligence for Cboe Global Markets. Big thank you for joining us today.
Great, glad to be here.
Fun topic, buffered ETFs.
Yes.
Hot topic.
Hot topic,
Yeah.
Very hot topic. We could spend hours discussing buffered ETFs, but I'd like to possibly roundtable it a little bit and talk about a few core subjects. The first is, we've all seen it in the last 4 or 5 years, what's driving the proliferation of buffered ETFs in the marketplace? Like, this has become a thing,
Yep.
right? It's a seismic shift in the marketplace, and be curious to hear what both of you think about what's propelling that.
Yeah.
Sure.
I think to me it's two factors. The first is risk mitigation and the search for a more reliable hedge, given the breakdown in equity bond correlation that we have seen over the past couple years. And then the second is ease of access, right? So I think, kind of going back to the first factor on the back of the breakdown in correlation, a lot of people are looking for alternative hedges. And one alternative that people have gravitated to is using options to more directly hedge your equity risk or your stock. So the stocks in your portfolio, and options is a great way to do that. But how do you access it? Because option-based strategies, while they have a great in terms of benefit, are sometimes hard to implement, hard to access, and that's where the ETFs really come into play. And we've seen, since the SEC rule change in 2019, just an explosion in option-based ETFs, and buffer ETFs has been one of the core beneficiaries.
So in your view, it's a bit about portfolio need and a lot about access.
Yeah, and then just the ease of trading, so you kind of reduced the complexity of managing an option-based strategy to just a simple ticker, right? It's as easy to access as buying an ETF or a stock.
Mm-hmm. Yeah, that is an evolution of the marketplace for sure. Phon, you see you're modeling for hundreds, if not thousands, of advisors at this point.
Yeah.
What's driving it from your perspective?
Yeah, I think just to add on to Mandy's points, I think behavioral aspect is pretty large, right? As investors approach retirement, they're looking for more stable returns, more risk adverse, and the buffer ETFs are like perfect for that. And it's that smoother ride, stable path. Like, we've seen the smooth ride on the portfolios we construct. Like Mandy was talking, with options in there, it like lowers the downside and then gives you a return to a cap. So the combination of behavioral aspects and that smoother ride, it's been great for those that are near retirement or in retirement.
Mm-hmm.
So.
Let's seize on that behavioral aspect for a moment and shift gears a little bit towards performance as well. So the behavioral aspect, I get, but I see this phenomenon now where, I've been in the business 30 plus years. It was always beat the market, or at least keep up with the market, right? And that's what drove the active-passive debate and a lot of the historic sort of discussion around performance. But there seems to be a shift towards what I like to call performance that's good enough, right? And it's not about necessarily beating SPY anymore, but it is about what I think blends both of your answers. One, the idea that because there's a democratization of derivatives now in the ETF shell, you can cater and tailor portfolios to specific investor needs. And the second half of that is the investor is starting to see that as, I don't need to beat the market, I just need to hit my goals. And so I wonder if that's a chicken and the egg thing, right? Is it the access to the buffered ETFs that have allowed them to do that, or was that all they wanted in the first place because of that demographic shift where it's volatility management, risk mitigation has become so important in their distribution years, right, versus their accumulation years. So I would wonder if you want to comment on that.
Yeah, I think it's a bit of both. I think the volatility over the past couple of years have shown people that returns, absolute returns by themselves, are not enough, right? Like, a strategy that beats the S&P by 1 percentage point but is twice as volatile is probably not palatable to a lot of investors, right? So this concept of risk-adjusted return has become more and more important. And then on top of that, the breakdown in that equity bond correlation I talked about, I think that's been like really important for a lot of investors, because you keep hearing like hold fixed income for the safety aspect of it. And then what happened in 2022? Fixed income sold off double digits, just like stocks, right? And depending on the duration of your fixed income portfolio, your bonds might have sold off even more than your stock portfolio. So I think that has really led a lot of people to look at the risk part of it and realize that actually historical correlations may not hold in the future, and are there other ways I can hedge my portfolio or mitigate the risk of my portfolio that doesn't rely on historical correlation patterns, and options have really come to the forefront as a result of that.
Yeah, just to add to Mandy's point, we like to say you can win more by losing less, and I'm pretty sure like Cboe and Mandy's team and other like shops have done these studies, and you see like if your portfolio is, when the market's down 30% and your portfolio is only down half of that, you don't have to make up that much to get back to break even. So like we have do buffer ETFs and defined outcome ETFs like give you that advantage, so you can win more by losing less. So that's a big factor. And like it's also, like Mandy said, ease of use. Like I started my career on the institutional side. We implemented all these option strategies for institutions, but now they're available via all these ETFs. So you can do a 100 buffer, which protects almost all your downside. You do a 10 buffer, protects 10% of your downside, but you have a higher cap. So you have all these tools available to construct a goals-based outcome portfolio. So
Let's talk about that for a second, the tools that are available. And lately, maybe the last 18 months, ticker soup. Like just tickers everywhere in the space. And so it puts a massive premium on education, obviously. But there's also a little bit of debate, and even amongst, shop by, firm by firm, what's the difference between a buffer and a defined outcome? Is there a difference? Do you look at it differently? Do you look at it as a similar product?
Yeah, to me, I look at it differently. Usually when I write an email, I'll say buffer/defined outcome. Yeah, I look at it the same. But one thing I do categorize, I think Mandy wrote in her paper, is like these covered calls or option-based strategies, or where they sell calls. I think that's a different category.
Yep. And
then we go into the buffer, defined outcome, structured payout profile. Those are the two large categories. Yeah.
Yeah, I would agree. I think in terms of the growth in option-based strategies and ETFs over the past couple of years, it's been the two. I would view them separately as well. People who are using options primarily for income, and people who are using options primarily for protection or for that defined outcome. But both have seen tremendous growth, and I think that just speaks to a lot of the things that we already covered.
Yeah, I agree.
Yeah, sorry. When we started analyzing the buffer ETFs, like in 2019 and 20, there were probably 40 tickers.
Right.
Now there's probably over 400, 500 tickers,
right.
Which is good for managers like me. Like it's almost like picking stocks.
Yeah.
These days. So yeah.
Yeah, it gives you a lot of optionality.
Exactly. Yeah.
That's I'm not even going to bother saying no pun intended.
Okay.
So is it fair to say, and in a second I want to talk a bit about how we incorporate these into portfolios, but is it fair to say that these aren't new strategies? They're just new to the retail or the intermediary space.
Yep.
Yeah, I think the payoff of a buffered ETF or defined outcome ETF, it's very familiar to a lot of people, right? You've seen it in structured note space, you've seen it in annuity products, but I think the wrapper is certainly new, and with it, it's made the payoff more accessible, more transparent, more liquid, and oftentimes cheaper to access. So I think those are all the benefits of this new wrapper. Yeah.
Yeah.
Yeah, I remember talking to an advisor, and he's like, why should we be paying the management fees above average? And he's like, why should we be paying that much? It's like, you can go do the options yourself, set up a margin account, pay the bid ask. It's like you're gonna end up paying more, and then you gotta spend time to roll it. It's like all in a nice ETF wrapper, and like it's like Mandy said, like it's more cost efficient, and you don't have to worry about rolling or setting up a margin account or something.
I think someone at AQR wants to talk to you about that. So, buffered ETFs, right? And this is my own personal opinion, because lately some people have said, have we peaked out, in the buffered space? Meaning, what is the next iteration of defined outcome that's going to take the market by storm? And in my opinion, and we as a firm, we got into the buffered space back in 2020, but my opinion is it's the first wave of structured product strategies jumping into the ETF world. Would that be fair to say?
Yeah, I think there's going to be a lot of more different payoffs that you're going to be able to see in the ETF form. Going forward.
Yeah, what's also very fascinating, I started my career on the insurance side. Like Mandy said, it's very fascinating. Like things are converging, like insurance, annuity payoffs, and structured products and ETF payoffs are like all converging into like a singular product or strategy, which is very fascinating for someone like me. I'm sure Mandy and you too.
Oh yeah. Well, let's talk about where the rubber meets the road.
Yeah.
Right, and Mandy, your white paper on this was, I thought, really well received and educational for all of us. But the idea that possibly the buffered ETF, or the defined outcome even, has, I won't say rendered the traditional asset allocation useless, but it certainly changed our perception of what traditional asset allocation means and maybe what it looks like, right?
Yeah, so I think that, so in the paper that we looked at, we were just looking at alternatives to the 60-40, right? Because that's come under so much focus in recent years. And like I mentioned earlier, if most people holding bonds hold it for yield and hold it for safety, for diversification, if both yield and the safety aspect is coming under challenge, are there other ways that we can achieve those outcomes by using options? So on the safety aspect, right, the defined outcome or the buffered ETF strategies have become very popular. So we looked at, in our case, if you were to take half of that fixed income allocation and allocate it to a defined outcome strategy, and we used our benchmark index for that. So the index itself is not investable, but it's meant to represent kind of the strategy more broadly. And we looked over back past 19 years, and we found that a 60-20-20 allocation, so 60% stocks, 20% fixed income, and 20% to a defined outcome strategy would have beaten the traditional 60-40 in 15 of the 19 years, with higher risk-adjusted returns in each of the last 4 years. So I think that kind of just shows some of the power of the strategy. Now, obviously, the exact allocation, can differ. It should differ depending on the individual investor's risk tolerance. But this is just a way to demonstrate that how incorporating an option-based strategy in your portfolio can have benefits.
Yeah, no, I think it's an important optic and illustration for everyone to see, because like most of us, and Phon, you can comment at this as well, but we need to see it. You need to actually see how it behaves in stress periods.
When I read,
and you've been through a few stress periods.
And when I read Mandy's paper, I was like, that's what we did. So like in 2019, we launched some of the first strategies that incorporate buffer ETFs, and we almost did exactly what Mandy did. Like we took half of the bond allocation to buffer ETFs, and then we also took a little bit of equity sleeve. So we had like a 50, 20, 30. I think Mandy's paper is like 60, 20, 20. Like Mandy mentioned, 2022 was a great year. It was our best year. We outperformed by a wide margin because bonds got sold off and the correlation broke down. Like our strategies with buffer ETFs outperformed, and advisors are very happy, and we got a lot more assets in. So when I read the papers, the light bulb, like Mandy just proved what we did, and like she said, better risk-adjusted returns, and we have better risk-adjusted returns. So
and I think the key here is that what drove that breakdown, that correlation that's been so damaging to the traditional 60-40 was inflation, right? So inflation was the catalyst that really took that correlation from the traditional negative correlation to positive correlation. So stocks and bonds now moving together. And as we know, inflation is not going away, right? Not only are current levels still fairly elevated, but when you think about the macro outlook, some of the trade policies, the fiscal policy out there, I think it's a risk that's going to be top of mind for a lot of investors for a while now. So I think given the uncertainty of the inflation outlook, I think that is going to continue that interest in looking for different ways to hedge your portfolio. Yeah,
that makes a ton of sense. And it sort of shines a light on the idea, look, past 25 years, right? We've had some really big drawdowns, whether it be 08, whether it be the pandemic sell-off. But it seems like 2022 was the one that actually broke the model a little bit, right?
Yeah, I think if you were looking just at the past 25 years, then definitely 2022 would have been the one that broke the model. But if you went back further, that negative, that positive equity bond correlation, that was actually the norm for about 20 plus years back in the 70s and 80s when we had persistent inflation. So I think that's why I point to that as a key catalyst, and why this new normal for the correlation regime might persist for a while, right? If inflation uncertainty remains, we might not go back to that negative equity bond correlation. So I think that's why people are looking for alternatives. You can't rely on historical patterns to kind of persist going forward.
Interesting. So it would be fair to say that we almost fell asleep. This was an intermission from inflation, the last 20 years or so, and we fell asleep on it.
Time will tell.
Time will tell. Phon, could you tell us how you're using these in models?
Yeah, so we developed some of the first multi-asset class strategies similar to Mandy's paper. And like advisors will allocate, replace 60-40 with our multi-asset strategy. And then after 2022, which with our good relative performance, we actually have gotten tremendous demand to create what I call dedicated buffered or defined outcome models. Those are 80 to 100%, buffered or structured outcome ETFs. And then the advisor can blend it to the risk tolerance of the client. So like we have a dedicated strategy, they allocate it to it, and then they can do whatever they want on the traditional or alts bucket. So that's how we've evolved.
What are you looking for next? Like if you look at the toolbox,
Yes.
and you've got more tools than ever,
Yes.
but you're likely missing that screwdriver or wrench that really puts it over the top for you.
That's a great question. I think it's income. I know Mandy's mentioned in her paper about income, and I think a lot of the income strategies, curious what Mandy thinks about, is there's a lot of risk in some of these income strategies that are coming out. Like, don't want to get too geeky, but you're selling some of these put strategies or call strategies. You're selling vol, and I'm not sure you want to be short vol. So I think some more sophisticated monthly income strategies, again, also borrowing from the structured product space, but more stable income, not as sensitive to volatility. I think that's where the next generation is. Yep. So.
It seems like you agree with that.
Yeah, I think it's moving across asset classes, so option-based strategies on other asset classes, whether it's looking at credit, with fixed income, crypto. I think that's one trend that we've seen. And then within the option-based strategies, for equities, we've seen people look at different tenors, right? Particularly, I would say more on the income side, people are looking shorter and shorter dated. As we know, more and more the option volume is going toward the shorter part of the curve. So those are kind of the two trends that we see going on right now.
So at Cboe, and obviously Cboe's been a leader in derivatives products for as long as I can remember, how much are the new creations at Cboe catering towards this trend? Is it a hot topic at the office?
Oh yeah, for sure. We want to meet customer demand, right? So we were always talking, to customers, ETF issuers, institutional investors, retail investors, in terms of how can we help in product innovation and bring products that people will actually trade. And I would say we have products that kind of range in terms of sophistication to really cater to kind of every part of the market.
Yeah. Well, I promised both of you I wouldn't take a long time with this, but before we leave, Mandy, can you tell us where the best place to find your research is? Because I know you're a leader in the industry, and I think everybody should have access to what you do.
So we have derivatives market intelligence. We have our own website, and if you just Google it, you can sign up for our distribution list. We put out weekly content, thematic, I would say monthly content. We have webinars, we have videos. There's a lot of different ways to consume our content.
Okay. You have to these days. And where can we consume your models? How do we find those?
We're on various platforms, like AE Wealth is a platform we work with a lot, and actually you can access through, Fidelity and Schwab. So trying to broaden the access points. So, yeah.
Well, thank you both for your time. And I know that you have busy schedules, particularly here in New York, and you took time out for this. So really appreciate that. Once again, I'm Mike Loukas, the CEO of TrueShares, and joined by Mandy Xu, the head of derivatives market intelligence at Cboe, and Phon Vilayoune, the founder and CIO of Veta Investment Partners. Thanks again.
Thank you.
Thank you.